Welcome to this Killick Explains video, and welcome to a new take on a topic I've done before, and that topic is it better to invest via a lump sum or is it better to invest by dripping money in bit by bit? And here's the point, both of those methods will potentially pay back over the long term, but they do ignore a more fundamental question, which is, are there times when it's better not to invest at all? Are there times when it's even better to look at what you have invested and sell up? And that's the topic I want to cover today, because people spend a lot of time worrying about which investment method might work best, and sometimes that can overshadow the fact that they may actually not be about to make the right investment or may have made a mistake in the past. So here's the point. One of those methods, lump sum investing or pound cost averaging, dripping into the market, will normally work, but if you're buying a bad investment, neither of them makes any sense. All right, so basically with a lump sum you'll lose money quickly, and with pound cost averaging you lose it more slowly. Now, an example of what I mean, and this was one that I suffered, if you like. I bought shares in an outsourcing services company a few years ago for £2. I won't name the one, but it was a big listed outsourcing services company. It ran into trouble, all right, and the share price dropped from £2 quite quickly to £1.50. So I thought I'll buy some more shares because they're now cheaper, all right. Then the share price fell to £1 and I thought I'll buy some more. I'll buy on the dips, I'll average down. Then the share price fell to 20p, and at that point I thought it can't get any cheaper. Time to get in, it's a bargain. I'll average down some more. And then the company went bust. The share price went to zero. Now, what were my mistakes? And these are just worth reiterating here. Number one, I failed to see that things had changed. This outsourcing servicing company used to be a great investment. I hadn't done my homework. I just got a bit lazy and thought, I'll buy on the dips. I'll go for an average down, pound cost averaging approach. I won't commit a lump sum, but none of that matters because circumstances had changed. This was not a company that I should potentially be investing in anymore, no matter how clever the technique for investing, if you like. So I was also throwing good money after bad, and that's another mistake. People don't like to admit mistakes. They think if I just put a bit more money down, like a gambler, if you like, I'll get it all back and everything will be fine. But it doesn't always work. You can simply chuck good money after money, which frankly you're never going to get back. Thirdly, I was hoping to recover my sunk costs. Every time I bought at a lower price, I thought, well, I need to try and get back the money I committed a month ago. Now I need to get back the money I committed last week. Now I need to get back the money I committed yesterday. But sunk costs are what they are. It's a bit like, opening a restaurant, let's say. It does well for a while, then the style of food you're offering drifts out of fashion. All right, people start to leave. So you think, well, what do? Do I refurbish it? Do I have another go? Or maybe it's time to pack up and move on. Now, those are tough decisions, especially if you're running something like a business, but they're also valid decisions and they apply in the investing world. I was too proud to admit defeat, I'll be honest. I thought, I've done my homework. I know what a good outsourcing firm looks like. I've done some ratio analysis, done some trend analysis, but all of that had drifted out of date. And I was thinking, no, my original assumptions are still correct. And actually what I should have done is a bit more homework, just to test whether in fact the original assumptions on which I bought still held, and it turned out they didn't. And I failed to understand the word contrarian, and this happens a lot. I thought I'm going to go against the crowd. The share price is falling, but if I'm clever, if I am brave and I get in as it dips, I'll make money and other people won't. Well, being a contrarian isn't simply about not doing what everyone else is doing. There has to be a little bit of intelligence behind it, because sometimes the crowd are right, and that means that if you go against them, you'll simply get dragged down, as I was, all the way to the bottom. All right? So, 5 ways to get better at dumping dud stocks, which is exactly what I should have done, and we'll finish on these 5 points, my 5 sort of takeaways, if you like. Number 1, you do need to think as an investor. If you're picking stocks, for example, to add to a portfolio, you need to think about, have circumstances changed? Are my original criteria still valid? And hopefully you've got a note of those criteria, right? You're not just winging it. Do I still have a business case for investing? And maybe what I should be doing is actually stopping or even selling what I've currently got, all right? Accept mistakes, all right? Accept that sometimes you'll get your investments right, sometimes you'll get them wrong. Unfortunately, survivor bias, as it's called, means that people tend to talk about their successes. I used to brag about my success in buying this outsourcer when the share price was rising, but I kept pretty quiet. I'm only telling you now, if you like, as the share price started falling. Ignore sunk costs. That's really important. Once you've spent money, you always need to be thinking about, will I recover it in the future? There's no point in regretting the past. You can only look at where we are now and look ahead. And if the future looks a bit grim for a particular company, stock, index, sector, or theme, maybe it's time to revisit your investment strategy. Cut your losses, all right, is number 4, and move on is number 5. Sometimes in investing, you have to basically eat a little bit of humble pie and say to yourself, I did make a mistake, it's time to move my money on. Because if you think about it, every moment that your money is locked into a losing investment, potentially it could be earning something somewhere else. So there is an opportunity cost, which is a concept that's not well understood. People think, well, if I leave my money there, eventually things will come right and that will be fine. But if they don't come right, you've lost out on an opportunity elsewhere. And even if they do, maybe you could have been earning a better return quicker elsewhere. Okay, so those are my top lessons, if you like, from the sorry tale of me not realizing that circumstances had changed around a particular stock. So bear those in mind. If you'd like to know more about some of these topics, we do have an extensive library, killick.com/learn. You might want to look at, say, the shares tab, for example, or the investing principles tab near it. And if you'd like a copy of my guide, How to Invest in Equities, which contains some of my classic investing errors, some of the mistakes I've made, and some of the ones I haven't covered today, then it's editor@killick.com, and I'll be more than happy to send you a copy.